Good morning, ladies and gentlemen, and welcome to the Harmony Energy Income Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet Company platform. Before we begin, I would like to submit the following poll, and if you would give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to Managing Director Paul Mason. Paul, good morning, sir.
Thanks very much, Jake. Good morning, everyone, and thank you very much for joining us for what is our second Investor Meet Company presentation. This morning, we're just going to take some time to step back, look at the big picture around battery storage. What's the overall view? Why are we here and why are we doing it? And has anything changed? Revisit the achievements of the Income Trust over the past 12 months. A bit of a discussion around the current share price and the challenges that we're seeing in the battery sector, as well as the investment trust sector more widely, and then also give a bit of a deep dive into some of the revenue performance of the projects and the drivers behind that and where we see that going. So that's the broad agenda. Myself, Paul Mason, and Max Slade here doing the presenting today. I'm the Managing Director of Harmony Energy Advisors Limited, the investment advisor to the Income Trust, and Max Slade sits on as an investment director in that vehicle as well. So in terms of the market backdrop, I think the key message we wanted to get across is really nothing is fundamentally different from when we IPO'd. The whole driver behind battery storage is around that drive towards net zero, increased renewables, and needing to store that renewable power when it's not needed and release it back onto the grid when it is needed. Nothing's fundamentally changed in this space. The net zero targets remain in place. Renewable build out remains strong. And battery storage continues to lag behind the national grid targets for where we need to get to enable that net zero transition. So in that sense, although there are clear challenges which we'll come on to talk about in the sector, we wanted to just step back and point out that nothing has changed. In terms of what batteries are doing to support net zero, appreciate that not everyone on this call will be familiar with the battery space. So just at a very high level, batteries are doing a couple of important jobs. The first one being providing vital grid stability services for National Grid, who are operating the electricity system, so helping grid to maintain the frequency of the system at all times. And we do that through contracts called ancillary services. We'll come on to talk about those in a bit more detail as we go through this presentation. But those are short-term contracts with National Grid to provide those services. And then secondly, we're sort of buying power when renewables are producing more than demand. So typically overnight, if it's windy, demand is low, we might buy that power, store it, and release it back into the grid in the evening. And there's a price differential between those 2 points. So that allows the business case to for buying and selling power. And we refer to that as trading. And we do that through the wholesale markets, but also increasingly through the balancing mechanism, which has been a bit of a hot topic in the sector over the last 12 months or so. So we'll come on to talk about that a lot more detail as we go through, but just to sort of set the scene of where we are and where we're still headed to. Max, do you want to take us through the broad investment case?
Yeah, so just as Paul said, for the benefit of those who are not so familiar with heat, we are an exclusive battery storage commercial battery storage investor. We buy projects at the shovel-ready stage, so pre-construction, and then we fund the build of those projects, and then we hold and operate them through their life cycle. We are totally focused on the GB market, Great Britain, not the UK, because Northern Ireland is on a different grid network. We target a total return of 10% unlevered per annum. We are the only exclusively 2-hour duration portfolio, and the 2-hour duration is very important. We will discuss that in more detail later on, but fundamentally what we mean is for every single megawatt hour, it's possible for a battery to have a longer. It doesn't necessarily mean it's got the same number of megawatt hours. So it's about the translation between power, which is megawatts, and energy, which is megawatt hours. So a 2-hour duration basically means that, say it's a 100 megawatt battery, a 2-hour duration battery would mean that we have 200 megawatt hours, which means we can supply 100 megawatts for a 2-hour duration in a single discharge, full to empty, and also charge at 100 megawatts for 2 hours from empty to full. And this puts us in an advantageous position when it comes to certain revenue streams, which again we'll go on to in a bit. Myself and Paul, along with the wider Harmony Energy team, have been operating in the battery space exclusively since its infancy, so circa 2016. And so we have a wide range of experience. We have a good team, a strong team behind us that deals with not just the project management for during the construction phase, overseeing that and supervising our contractors, but also through the asset management during operations. And we've built up a good data platform which we use to monitor daily operations of our assets, which enables us to monitor not just the revenues on a minute-by-minute basis, but also the ongoing technical operations and maintenance work, and just coordinating any outages where we have to shut down part of a project to do some maintenance work, and we coordinate that with the revenue optimizers who are trading the asset on an hour-by-hour basis. So it's a strong team. We also in the background have a development team, which is not part of the investment advisor, but it's to the side, and it's preparing our pipeline, of which we have exclusive rights over 500 megawatts. So when we IPO'd, we basically reserved 1 gigawatt of Harmony Energy Limited's pipeline projects under a right of first refusal. Our portfolio currently stands at 395 megawatts, so we have just over 500 megawatts of that left, and they said we will be offering those into the trust for acceptance as and when they are ready, but obviously that's subject to fundraising. And then the other point worth making is the alignment. So Harmony Energy Limited, as the developer and also the owner of the investment advisor, has a 12.5% stake in Heat PLC, and then together with management, that represents another 3 to 4%. So we are a significant shareholder in our own right in the PLC.
And just to pull out a few of the key numbers right now. So we released our annual report and results last week, and simultaneously released our NAV update as at the 31st of January. So we focused really here on the January numbers as being the most up to date. But clearly, please do go and look at the annual report and read through that for further information on what's happened over the prior financial year. I think the key number I want to focus on here is really in the bottom left-hand corner, and it's that GAV per megawatt. It's really becoming apparent that there is a disconnect between the way that the share price is valuing these projects and the way that the wider market and the private pots of capital are valuing these projects. So I think to move slightly away from looking at net asset value or on a sort of absolute or pence per share basis, it's helpful to contextualize this by looking at the price per megawatt. So we've gone on to do a bit of a comparison here, just to put the current share price and market cap in context of what does it cost to build a new project, and we, based on current tenders, so very live information from competitive processes, to buy the rights, construct a project, so buying the batteries, buying the transformers, all of the contracting and civils works. We estimate that to be about £750,000 per megawatt. Now that would equate to a share price of about 73 pence per share in our case for the Heat portfolio. But that doesn't take into account the time that it takes to actually take that project from giving notice to proceed, starting construction, and getting an operating project. Adding in the cost of capital over that time would increase that 750 to £908,000 per megawatt. And that would be equivalent to a share price of about 101 pence per share. So pretty in line with the current net asset value as at 31st of Jan of 104 pence per share, or that £919,000 per megawatt gross asset value. And that's for a portfolio which is now 70% operating. So I think when you look at it like that, and you take a step back and see that there are private pots of capital making these investment decisions, starting to build new projects, the demand for the projects has not gone away. And the share price is not reflective of the value that others are seeing in the market. So it does point to a slight disconnect between what's happening in the listed investment space and what private pots of capital are able to do. And we'll come on to why that might be. I think there's a range of factors, and it's an investment trust supply and demand capital issue. But the battery space has been particularly impacted, and I think that's around the revenue profile and the variability of that revenue. And we'll come on to sort of talk about what the drivers of the current revenue performance are and why we see that fundamentally changing over the sort of medium to long term, and why that investment case still remains very valid.
So just looking at our portfolio, just as a reminder of where we've got to, it is important to point out that when we IPO'd, we set ourselves certain targets in terms of the build out, the rate of delivery of the build out of the portfolio, because when we launched, we had no operating assets. And so it's actually been a tremendous achievement for us to build out 5 assets since IPO, 555 megawatt hours. That is the second largest operating portfolio in terms of megawatt hours in the country, and we've achieved that from a standing start effectively. So if you step back and look at what we've delivered since IPO in the context of the wider battery storage market in GB, our rate of delivery has exceeded all others, and that's exceeded and has met our targets. And to do that in the current environment with supply chain issues, high inflation, long lead times, or lead times increasing significantly on certain key bits of equipment, it has taken a lot of effort, and it's a credit to our delivery team and the high level of supervision and pressure that we put on our supplier partners. So that is actually to be applauded, and I think it's unfortunate that we are now in a period where we've come into the market and we've begun operating, but we've hit this low period of revenue trading and revenue environment, which is not what we were building up to. But we definitely have delivered what we said we were going to deliver in terms of project delivery. This is some visuals of the 5 operating assets. Pillswood being our flagship asset, the first one that came online in November 2022. And it was the top operating battery in the country in terms of revenues throughout the calendar year of 2023. The Bumpers project, bottom right, is ever so slightly larger, being 198 megawatt hours versus Pillswood's 196. And at present, the Bumpers project represents the joint largest battery project in the UK, having overtaken Pillswood. There is one other project which is also the same size as Bumpers, which coincidentally was also developed and delivered by Harmony Energy Limited, but under a separate private joint venture which was put in place prior to IPO. So it's important just to note that in terms of building out the biggest and the best, that is our track record. The next slide shows the 3 projects which are still under construction. The top 2, these pictures were taken back in December, but it shows that the best units have been delivered on site. These 2 projects are not Tesla projects. Out of the 8 projects, 6 of them are Tesla supplied, and 2 of them are supplied by a company called Envision. We wish to diversify our supplier base, and this was one of the core risks that we listed in our prospectus, was that there was a supplier concentration on Tesla, and so as part of prudent management of that risk, we deliberately went and diversified that supplier base during 2022, and so offered these contracts to Envision, who scored very, very highly, very, very strong pricing and very strong ESG credentials. So we're really excited to be working with them. And the Russia project is a Tesla project. Out of all of our initial our 6 Tesla projects, this is the only one which has been significantly delayed, and that's through no fault of Tesla or no fault of our project managers. Unfortunately, it was an issue with the distribution network operator, Northern Power Grid, and their access rights to the nearby substation, which, unbeknownst to us, that they've had some legal issues trying to access. So that is now sorted out. We have now people on site. In the meantime, we went on and built the main site. So as you can see there, all the Tesla Megapacks have been delivered and fully installed. It's just now the DNO needs to complete its works, which is about half a mile up the road at the substation. And they are mobilized and on site there. So we have the program for that, and everything is now running in accordance with that program. All of these 3 assets should be coming on by the end of Q2 this year. So we should be 100% operational by the end of H1.
Great. And just to point out, because we have been asked this question, but the Envision batteries are not blue. Those are just covers that are covering the batteries whilst the remaining works are being done, just to keep them protected. But they are nice and white, like in the same way as the Tesla projects. So just to touch on the performance from a revenue perspective of the heat portfolio. So I think this chart shows a couple of things. So the first thing I want to pull out is very clearly that we had, for the majority of the financial year ending October 23, we had only 120 odd megawatts operating, so a relatively small part of the overall portfolio. So revenue growth, first and foremost, will come from bringing on those remaining projects. So in October 23, we brought on just under 150 megawatts of additional projects. So that's a big boost to the revenue generating potential of the portfolio. Simultaneously in October, we started to receive capacity market payments. So as new build projects through the capacity year that started in October 2022, we could not participate in those in that capacity market, but we did bid and win contracts to start delivery in October 2023. So this grey bar starts to increase, and from this point onwards, we have capacity market revenues locked in for a large portion of our portfolio. There's some detail around that in the annual report, so you can see what that looks like. But it's a mixture of contracts that are T1 contracts, so 1 year into the future. We just won a lot of contracts for delivery from October 24. Which were very well priced. So that's a good improvement that hasn't yet flowed through our valuations. And then we're starting to get into the longer term contracts. So T4 contracts, they're set 4 years in advance. And as new build projects, we were able to lock in 15-year index linked pricing. So we have that now on the full portfolio, those 15-year contracts coming on sort of staggered across the portfolio, but starting to come on next year, and then over the following 2 years, those T4 contracts are coming into play. So the portfolio is very well covered from a capacity market perspective now.
It's worth just pointing out, there's been a couple of questions on this. The T4 auction, which cleared last week, our portfolio did not participate in that auction because we had already won T4 contracts, 2 of which are coming into effect from October this year, and then the remainder are coming into effect either next year or the year after. So we did not participate in that auction, having already won contracts for future years.
just on that, the price, the T4 price last week was a record price, but capacity contracts are subject to what's called derating. So to get the full value of that price, you actually need to show you can deliver power for 9 hours now. And batteries are derated depending on duration. So the derating for the auction last week was actually a harsher derating than we have on any of the T4 contracts that we have within the portfolio. So on a net basis, the contracts we picked up last year at a very slightly lower headline price are more valuable than than we would have received on the record price from last week. But the other key point I wanted to pull out of this slide was the shift in revenue mix away from these green bars of ancillary services. So as I mentioned earlier, these are those short-term contracts with National Grid providing services to maintain frequency. And we're shifting towards trading revenues, being the orange and the blue bars here. So orange is wholesale trading and blue is the balancing mechanism. So the traditional wholesale trading, as I said, is sort of buy a block of power overnight, sell that block of power in the evening, and realize the spread between the lower price overnight and the higher price when demand is high and we're using less efficient fuel forms in the evening. The balancing mechanism, for a very long time, we have been saying should be where batteries end up. That should be the go-to place for battery storage. And that is a market where the wholesale markets close 1 hour before delivery of power, and National Grid then has 1 hour to buy and sell power in order to balance supply and demand in real time. So they're often taking conflicting actions to get to exactly the amount of power they need, and that's quite inefficient right now. But batteries offer a more efficient solution to National Grid, and they simply aren't being used enough because National Grid has not had the software tools in place to allow it to make use of battery storage. And that's really because the legacy software was all based around big power stations delivering hundreds of megawatts at a time. So if National Grid is trying to buy 500 megawatts, and they can do that by buying from 1 or 2 big gas power stations, that's easier for them to do than it is to buy from 20 or 25 battery plants. So they did introduce a new software launched in December, very quickly paused and then relaunched in January, and we'll come on to show what we're seeing from that. But that represents some positive movement. We're not quite there yet. There's still work to be done, but I think there is a lot of work going into making battery storage much more accessible within the balancing mechanism, and we hope and expect to see the blue element of this bar really grow over time. And the final point to pull out is this shift in ancillary services. So you'll notice that we have a negative section to the ancillary service in January 24. So that's because some of these services, the net result of providing the service is that we end up with a full battery full of power. So to provide the service, National Grid wants us to consume power. So we're actually happy to pay for that, provided it's cheaper than we would have to pay to buy that power on the wholesale markets. So that's an increasing sort of trend that we're seeing in the market, where you pay to provide certain services because that's a cheaper way of buying power than you could do in the wholesale markets. And we expect this trend towards trading and away from ancillary services to continue. And this really plays into, and it's what we always expected, that's why we launched this 2-hour duration portfolio. And that's because if we have 2 hours versus the national average of 1.3 hours, we've just got more power to buy and sell. So we've got more volume that gives us access to more revenue. So this was the trend that we always thought was going to happen, and it's playing out as expected. I think one of the key themes clearly, though, has been that revenues have declined over the year. and that's true for all durations. And this is coming down from really the highs that we saw in 2022, and the forecasts that we had expected that decline to happen, but expected it to happen more slowly than we've seen. And there are a few drivers of that which we'll come on to. But on this slide, what I really want to pull out is the fact that the 2-hour duration batteries continue to earn greater revenues than their shorter duration counterparts. And you can see that's a combination of the underlying trading ability, but also the capacity market, with those derating factors really coming into play. 2-hour batteries earn much more money in the capacity market than 1-hour batteries. And this is not linear anymore as well. Derating factors used to be much more linear. They're really now penalizing shorter duration batteries and trying to encourage some longer duration into the mix. So we're seeing that gap continue. We expect that gap to widen, actually. So because the 2-hour batteries have got more ability to play in those wholesale and balancing markets to make the most out of those markets, whereas the shorter duration batteries are more reliant on ancillary services, which are quite shallow markets and are now saturated. We expect the gap between this 2-hour and 1-hour battery revenue to continue to widen.
Yeah, this is a theme that we highlighted during our IPO roadshow, that the main benefit of a 2-hour duration battery versus a shorter duration battery is that it not only allows you to outperform during a high spread environment, if you're predominantly trading, which we would be, it also allows you to minimize and protect against the downside in the scenario where ancillary services become saturated, and you are much more exposed to that downside as a 1-hour battery than you are as a 2-hour battery. So we are proving, well, over the course of 2022 and 2023, both ends of that spectrum have been proven in terms of outperformance during the good times and more protected downside in the bad times.
And so this is highlighting the current revenue situation we find ourselves in, which as I say is lower than we had been forecast and had been expected. So we're going to come on to talk about some of the drivers behind that, but also some of the reasons that when we take a step back, we don't feel that these will persist over the medium and long term. So if I look at the chart in the top left to begin with, you've got two key commodity prices on that chart, being the natural gas price and the carbon price. So the natural gas price in blue and the carbon price in the darker and the black color. So they've both come down significantly over the last 12 months. And I think whilst the gas price was expected to come down, forecasts back in 22 and through 23 expected that decline to happen over a longer period of time, as it took Europe longer to sort of move away from Russian gas supply. We've had 2 very mild winters, which has played into this. And that means that European gas storage remains very high in historic terms, and therefore that's taken pressure off that gas price. The bigger, I suppose, surprise is really this carbon price reduction and how quickly that's come down. And this is where I think if we step back and look at the overall picture around net zero policy, where we're headed, what's going to happen with demand as we electrify heat and transport, it really isn't a feasible outcome that carbon pricing remains at that level. And you can see that in the chart on the bottom left. So the gas price actually remaining relatively stable over the longer term, but the carbon price predicted to have this fairly rapid increase over the 2020s, and that translates into the chart in the bottom right, which is showing the wholesale spread. So this is the difference between the cheapest bit of power in the day and the most expensive bit of power in the day. So this is the spread that we can capture by trading in the wholesale markets, either day ahead or within day. And that's obviously underpins the business plan and the revenue expectation for battery storage projects over the long term. And it's this expectation that's coming back to that sort of differential between the way that the listed funds are performing from a share price perspective and the values that we're seeing in the market, and and the cost of build, and the fact that people are continuing to build these battery projects, is this expectation and belief that spread has to increase as we get carbon price increases, driving higher peak power prices, but greater renewable penetration, providing more periods where we can buy that cheap excess renewable power. So that's what's driving that spread over the long term. And fundamentally, nothing has really changed in the picture from that sort of long-term perspective. And just to visualize that demand growth I talked about, we're actually in a period of sort of record low demand, and we've dipped partially in the last couple of years in reaction to the very high pricing that we've seen. And this is a global thing, not just a UK thing. So one of the big drivers of that gas price decline has been a lack of demand switching back on in Asia. So we can very quickly see these things turn around. But the key drivers from a UK perspective are this electrification of heat, transport, and then a bit further out coming into hydrogen production, which is forecast. So that demand growth is huge. So we've got a doubling of demand by 2060, and that, along with the renewable penetration, is really going to drive those wholesale spreads that we expect to see. Wholesale spreads are only part of the answer in terms of what we expect to see for battery revenue. So I said we'd talk about the balancing mechanism. So this is why we're so interested in the balancing mechanism. The blue line here is showing the average spread. So we've smoothed it out a bit, looking at 7-day averages. But this is the wholesale spread with the blue line, and the black line showing the balancing mechanism spread. So you can see there is a structural difference between those two numbers. And we've seen this consistently over many, many years, where National Grid in the balancing mechanism is asking people to move away from the position they would naturally be in, and they have to pay a premium to do that. And that's what drives this spread. And we demonstrated this. We ran a trial by putting one unit of Pillswood into the balancing mechanism exclusively over May and June. And we saw the spread was there. We saw that we could outperform what the revenue we could get from the wholesale markets and mixing wholesale markets and dynamic containment. The barrier to making that a viable strategy was really the volume we could get. We could only get cycling of about 0.6 times per day, when we would like to be cycling in the region of 1.5 times per day. So we were sort of about a third of the volume that we'd like. But we saw that the revenue potential was there if National Grid were able to make better use of the battery
and increase volume.
Yeah. And that's really the driver behind this new software. So National Grid, as I say, launched their new software in December, had a bit of a false start, and then launched it properly in January. So the software is OBP, that's the Open Balancing Platform. And over time, this is intended to totally replace the balancing mechanism. So at the moment, the balancing mechanism is pretty manual, and it relies on engineers dispatching assets individually. This software is designed to automate that and make it much more efficient to drive costs down to the consumer. But National Grid has launched it specifically looking at trying to drive batteries, battery volume, and small balancing mechanism volume. But the majority of the assets that we're talking about in OBP are batteries. We've seen about a two times increase in volume since OBP launched, and that's encouraging. But it's not far enough, and it's not where we think it can get to. And I think one of the issues we've seen is actually that it's not being used consistently yet. So when it is being used, it works very well. And we look at our screens that monitor performance, and we see just a sea of balancing mechanism actions, and that's great. But the next day we might get 0. And this is really less around the OBP software itself, but actually it's around how much volume the National Grid control room is allocating to OBP. So there is a human who is deciding how many megawatts to put into this new algorithm. and that seems quite variable right now. And that's one of some of the feedback that we're giving to National Grid, and trying to work with them to understand what's driving that and how can we improve the amount of volume that's going in there. And I think it's worth saying that we are seeing, National Grid is very incentivized to do this. They're making a lot of statements around their desire to do this, and we are seeing action. So National Grid has announced one key change, which should increase the volume that's allocated to OBP, which is ditching what was known as the 15-minute rule, which meant batteries would only ever be dispatched for a maximum of 15 minutes, and making that 30 minutes. So that should give the control room a lot more visibility around what the capability of the battery fleet is at any moment in time, and that should in turn drive confidence to allocate more volume to OBP, which should directly flow through to more volume and more revenue potential for battery storage. That's now was originally due to go live on the 1st of March. It's been pushed a little bit to the 12th of March, but we're expecting that to come on very soon, and it'll be interesting to see what impact that has. But it's just one example of the efforts that National Grid is making to really push this, and I think we're encouraged by the direction of travel. We always want it to be faster and bigger and better, but I think very clearly the intent is there, and it will come.
But it's important to know that it's not just National Grids and the volumes and the balancing mechanism that is going to increase revenue significantly. The underlying wholesale spread also needs to go up in order to support that balancing mechanism. The balancing mechanism allows batteries to outperform the wholesale market, but if the wholesale market is low, then ergo battery mechanism revenues will also be low. So the two are interconnected, but for us, the outperformance comes from the balancing mechanism, and it's what we see. The trend is in the right direction.
I think that said, so we have just revised our near-term revenue assumptions downwards, and we've done that to reflect the reality that we're seeing in terms of performance right now. So the assumptions we use for valuation purposes, they are all they're based on forecasts we acquire from third parties. Those third parties are looking at long-term averages. They are looking at based on the sort of an equilibrium sort of system where everything is perfectly balanced. The right amount of technology is sort of always built, and that sort of makes sense for a long term. But actually, you can see very sort of significant variances over short term, because it doesn't factor in sort of one-off events, combinations of factors. It's based on average weather. It's not looking at big plant outages and that sort of thing. So it does mean that you can see periods where actual performance is significantly higher, as we did in 2022 and parts of 2021, early 23, but also periods where actual performance is lower. So we've reduced the first 2 years because that's what we have some visibility over. We haven't touched the later years, and we expect we'll get new forecasts out in April, and we'll be revisiting, once we've got those new forecasts, what the correct assumptions for valuation are going forwards. But we did think it was important to reflect the reality that we're seeing, and also what we believe is the market expectation when putting out our latest valuation. So that's the change that we've seen here, and the dotted line is showing what we've reduced these from. But I think it's important that actually, not changing the longer term is entirely consistent with the message we've tried to get across today, in terms of the longer term. We don't see that the fundamentals have really changed, so we're not expecting big changes over those long-term revenue forecasts, and that's again backed up by the fact we are seeing people still building batteries based on these revenue forecasts and the current pricing of capex to build the projects.
Just to touch on ESG. So as I said earlier, one of our main pledges in our IPO prospectus was to deliver a portfolio of batteries through construction into operations, as according to a very ambitious timetable, which we've achieved. The other big promise we made was around ESG and our commitments around ESG. Fundamentally, building and operating battery storage is good for net zero. It enables the net zero transition, but that in itself isn't enough. We need to make sure that the way we deliver these projects is done in a responsible and environmentally, socially conscious way. So that's the two key limbs, and we've worked very hard over the past year to prepare the groundwork, do the market, the gap analysis, recruit into our team, and start reporting and collecting the data and putting the processes and various codes into creating those codes in order to allow us to baseline the data, so that we then have a foundation from which to grow and embed those ESG principles into our day-to-day operations. So that's this slide highlights the strategy, along with our strapline, powering a sustainable future, which is something we try and weave into all of our PR now. It's everyone at our level is, and on the investment management side and the board, are highly motivated and locked into this. And our non-exec board have been particularly very, very supportive in helping guide us through these processes over the last year. Just in terms of what we've actually achieved during 2023, as I said on the left here, so we've started collecting the key data, and we started estimating the amount of tons of carbon emissions that we are avoiding. So by definition, if we are charging during periods where renewable penetration is high, that effectively means that carbon emissions are low. So the more that we can store that low carbon energy and then put it back onto the grid in periods of high demand, which would usually be periods when thermal generation is operating, we are effectively displacing some of that volume. So we are avoiding carbon emissions doing that. So we've built into our asset management platform a way to overlay carbon emission maps against the time and the volumes that we are operating. So we are able to calculate the amount of tons of CO2 avoided, which is really, really helpful. That builds into our scope 1, 2, and 3 emissions under TCFD, which is a very onerous but worthwhile regulatory framework which we've signed up to. We are also looking very hard at biodiversity net gain, and the advantage of having a captured pipeline with a developer team sort of in our sister company allows us to work with them to embed biodiversity net gain processes and ideas right at the earliest stage during the planning process, before the company has acquired the assets, and that enables us to outperform on our biodiversity net gain targets and meet those. We also, on the social side, we also have launched 5 community funds. So every time one of our assets becomes operational, we set aside some money from revenues in order to support local community initiatives, and we send around polls within our internal team here to vote for the shortlist of those initiatives. So we've contributed, well, we are going to contribute £35,000 a year combined across those 5 community funds, which is being very well received, and we're getting a lot of positive feedback on that. We've also introduced a supplier code of conduct, looking at our underlying supply chain, and more importantly, the third-party suppliers in that supply chain. So not just Tesla and Envision as the principal ones, but also who supplies them and where do those key raw materials and key components come from. So we're working very hard with them in order to demystify that and make that more transparent. And that's part of the supplier code of conduct, which is also a key requirement under our various regulatory frameworks that we've signed up to. So going forward, we're going to continue collecting the data, use that to fully report on our UMPRI this coming year, having already done a dummy run in the summer just gone. So we're very well set up for that, and we're going to continue building on our TCFD and TNFD reporting. So we're very proud of what we're achieving here on the ESG front.
Great. So just to reiterate what we've said, really, the revenue market clearly challenges right now, but taking a step back, big picture, we don't think that the macro drivers have changed. We think that this is a short-term issue, and really spread growth through demand growth, carbon pricing and renewable penetration will drive performance over that medium to longer term. Shorter term, we see the balancing mechanism improvements as being a key driver of dragging up from the current performance, and we're seeing a lot of positive movement in that sense, and we can see that the future changes should make a meaningful difference alongside some other key new markets being launched by National Grid. We've got the remaining projects to come online in the next few months, and that's really the key focus for us, so that we get all of the projects operating, and we're well placed when revenues do recover to be making the most out of that. I think that concludes the presentation. So I think we've got time for questions now.
Yeah, that's great. I've been sorry if I've been off to the side here. I've been trying to curate these questions. First question is about changes occurring in the balancing mechanism since the 1st of March. Actually, there were advertised some changes. This 15-minute rule extending to 30 minutes was meant to come on into effect on the 1st of March, which actually represented about 6 months earlier than initially published and planned for. However, that switch on date has actually been pushed out to the 12th of March, so we're not able to comment on that yet, but we will be watching that with eagle eyes.
I mean, just to touch on, I touched on it a little bit, but in terms of what we expect to see, if the software's working properly, it shouldn't make a direct difference to the way the software behaves, because the software is very good at stacking lots of smaller actions together to get exactly what it needs anyway. But what it should do is really give the controller, the human, a lot more visibility over how much a battery can produce for the whole settlement period. So right now, batteries tell National Grid what power can they sustain for a 15-minute period. And that's okay, but it means that the control room doesn't know, if they run it for 15 minutes, they don't know if that's going to be sustainable for another 15 minutes, or whether actually after that point it's going to be 0, or if it's half of that. So there's this uncertainty that creates, and that could be a barrier to how much volume National Grid allocates to the open balancing platform in the first place. So it's actually, we expect that this extra visibility should be helpful for the control room to have more confidence to put more volume into OBP, and that should drive performance. So we're hopeful that will be a good positive step. But yeah, we can't comment on how successful or otherwise it will be until it launches on the 12th.
We've had 2 questions here which are linked, one of which asking about a certain analyst who made some doomsday predictions about the state of our debt covenants earlier this year, which could be linked to a trigger in the fall of the share price. That was erroneous. We were not consulted or asked to fact check any of those statements, and so I think the lesson there is don't believe everything you read. We've since had interaction with them and actually picked them up on another error they made, which they then issued a correction in relation to. But unfortunately, this practice seems to be quite common, especially with this one analyst. There's another question there around our investment advisory fee. Someone asking whether the manager will be taking reduced fees to reflect the fall in the share price. I can reassure you that we already are. Our management fee structure has always been that we charge our fees as a percentage of the lower of NAV or market cap. That is a more shareholder friendly than other of our peers, which is just based on the NAV only. So because of our depreciation in market cap, the investment advisor is actually being paid significantly less than we were a year ago. So we are very much sharing that pain. And on top of that, we have our significant personal shareholdings in the PLC as well. So again, a different analyst got that wrong too and didn't bother checking with us, or even obviously reading the prospectus before he made that comment.
Just to pick up on the debt piece, we are engaging with all analysts around the structure of the company and particularly the debt. I think the timing of that particular report was unfortunate. As you'll have seen, we actually announced the restructuring of our debt just a week or so ago. or a couple of weeks ago, and that the publication of that was prior to us announcing that restructuring. So we were in a slightly frustrating position where we couldn't go out and talk exactly around what the new structure was, because it hadn't been announced at that time. So I think that was slightly unfortunate timing, but we are actively engaging with all analysts to sort of make sure everyone's clear on what our fee structure is, what the debt structure is, what's our position around funding remaining projects, all of which is covered in the annual report, so the information's there, but we are trying to ensure that everyone is guided to that accurate information.
Yeah, clearly we're constrained by confidentiality in certain respects on sort of some elements of commercial contracts, but ever since we listed, the cry from the analyst community has always been, please give us more transparency and a greater level of granular information to help you guys demystify the battery business case. And we really have tried to do that. I think we've done a couple of sector firsts in terms of publications of extra layers of information, and that has led to others following suit. So I think we have tried very hard to be as transparent as possible. Quick question here about, or just on the share price as well, about why some of our peers have bounced back a bit recently, whereas we haven't. I think fundamentally that debt question may have held people back. We hope to have now allayed any fears around that with our recent refinancing. I suppose the only other thing we can think of is a scale issue, as in we are the third and still mostly, well, the least mature, I guess, of all of the funds. So that may be something to do with it. But fundamentally, I don't understand, because we feel we have a portfolio from a technical basis which is best positioned to maximize performance in an upward trend, much better than our peers. And so, given that we have a solid foundation from which to do that, there's no real reason why we should be considerably lower than our peers.
Okay, there's a question here around would we consider realizing any assets once conditions may be more favorable in order to increase financial flexibility. So yeah, we've announced that we are considering the sale of one or more assets, and that we would use the proceeds of that to deleverage, potentially implement some share buybacks. And yeah, I think it would give some flexibility. I think that the trade-off is then around scale, as Max was just saying, and what does that smaller portfolio look like, and how much flexibility does that smaller portfolio have to take advantage of varying trends in the future. So that's some work that's ongoing, and we'll update the market once that review has completed. But it's definitely something that we are looking at.
And as a follow-on question to that, there's a question around dividend policy. So we've announced, unfortunately we were forced to postpone the first financial year quarterly dividend for this current year, which would have been paid in March. We are keeping the rest of the dividends for this year under review at this moment, and we, as part of what Paul was just saying, basically stepping back and analysing our options in terms of potential asset sales, exploring some longer-term contracted income that we may or may not be able to source from third-party suppliers, basically shifting that merchant risk, the volatility risk slightly. And we wouldn't do that for the whole portfolio, but we may consider doing it for a part of the portfolio in order to create that financial flexibility, as someone phrased it. There are a few avenues we can explore, and we didn't want to rush out with a non-properly thought through policy which would reflect a stable and sustainable dividend levels given the current revenue environment. So watch this space. We will be announcing something in the next couple of months, and but it's definitely it's our priority right now.
Okay. There's a question asking if we have any bids on our current assets and at what discount to NAV. So the answer is no, we don't. we do think there is interest, and since we've announced that we would consider selling assets, we've had lots of inbound interest and sort of people who would like to have a discussion. We have not yet had that discussion because we haven't completed the work to understand exactly what our strategy would be in terms of, do we want to sell one asset? If we do, what size would it be? Do we want to sell more than that, etc.? So there is a lot of work going on. But there's definitely interest, and in terms of as I say, going back to the slide we showed around that, the discount to new build and the amount of projects that are still getting built and funded, I think the NAV is pitched at a sensible level. Is what the way I'd respond to that.
Yeah, there's a question on buybacks. So I think the order of priority in terms of creating a greater level of operating free cash flow, order of priority in terms of how we would allocate that. Again, that's part of the strategic review that we're undertaking. However, there's obviously an argument to apply some of that to deleveraging partially, to lower our overall cost of debt. Buybacks, I think, would come as a second priority behind that. But it depends on where the share price is prevailing at that time. Obviously, at such a large discount as it is now, buybacks make a lot more sense, and it just would seem to be the most NAV accretive way to employ any operating free cash flow, rather than just pushing through a dividend. Do you want to talk about 2-hour costs? I mean, it's
so yeah. There's one question asking around. We said the cost of a 2-hour battery is £750,000 per megawatt. So I think the first point is to confirm that yes, that cost was for a 2-hour battery. How much would a 1-hour battery cost? We have not been out and tendered for 1-hour batteries, so I don't have an up-to-date price, but my guess would be that you're sort of at the 450,000 per megawatt sort of range, and maybe 500,000. But we don't have up-to-date tendering information because our portfolio is and has always been 2 hours. So
yeah.
I don't have the same level of confidence in that as I do around the 2-hour numbers.
Yeah. So, and there's some other questions around, do we take the additional cost into account when we talk about revenues? And obviously we do. The analysis we did at IPO when we decided to go into this exclusively 2-hour duration strategy overlaid the cost versus the revenue benefit, and the 2-hour duration did seem to hit the sweet spot of the best ratio between cost and revenue. It's not, 2-hour batteries do not cost twice a 1-hour battery. It's much lower than that, but the outperformance is significant. So it's also important to remember that in our current environment, we are fully funded to completing construction of these assets. So it's not a factor in our decision making now in terms of what duration do we go for versus the revenues we can get, because we are already building and have funded all of our assets. So in terms of a decision as to an investor may be making now, the cost versus revenue really isn't the relevant decision, isn't the relevant factor. It should be more about, does the share price represent good value for a 2-hour operating portfolio?
Sorry, there's a question. If I read it correctly, it says, does the refinance require consent from lenders in terms of declaring any dividends or share buybacks? So the answer is no. We have sort of standard debt covenants, and to the extent those covenants are met, we're able to take cash up from the holding vehicle where the debt comes in up to the PLC, and once we're there, we can declare dividends or buybacks as we see fit. So there's a lot of flexibility there, and actually I think it's structured in a way that gives probably more than standard flexibility to do that over the first couple of years. So no, is the short answer.
There's a question here about, have we taken further measures outside of securing CM contracts in order to hedge against seasonality and volatility of BESS revenues? The answer is no, not yet, but it is something we've always looked at. That is a sort of subsector of the market which has been evolving ever since sort of 2017. The problem is that, you know, there's always a trade-off between where you fix any sort of floor price that a third-party supplier may want to offer you versus the upside that you're giving up by doing so. So we are monitoring the market. We are waiting to see if there's a level attractive enough that would help us to, as Paul was saying earlier, sort of structure a blend whereby, you know, we can try and hedge against some level of flexibility, but we wouldn't ever want to lock everything away, because then we wouldn't be opening ourselves up to the upside potential of spike events or unforeseen sort of increases in revenues.
Right. I'm conscious that there's quite a few questions, but unfortunately we're out of time. So we'll go through the remaining questions. We will try to respond to as many of those as possible. But yeah, we have unfortunately hit time. So thank you very much, and I'll pass back to Jake to close off.
Perfect. Paul, Max, thank you very much indeed for your presentation this morning, and also for being so generous with your time there and addressing all of those questions that came in from investors. And of course, we will be able to give you back all of the questions, as well as any further ones that do come through, available immediately after the presentation has ended, just for you to review, to then add any additional responses, of course, where it's appropriate to do so. And we'll publish all those responses out on the platform. But Paul, perhaps before really just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Yeah, really just to reiterate, I suppose, the key message in terms of the delivery that we've had since IPO in terms of getting these projects online has been exceptional, and it's unfortunate that the revenue is currently so challenging. However, take a step back, the fundamentals are still there. The business case still makes sense, and in the short term, there are things happening with things like OBP that give us a lot of confidence that we come through this in a very strong way, and really the refinancing that we've just been touching on puts us on a really solid ground to sort of build on that and be really positive going forward. So that's it. Thank you very much for all of your time.
Perfect. Paul, Max, thank you once again for updating investors this morning. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Harmony Energy Income Trust PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.